Are you missing out on thousands of dollars in tax savings as a rentvestor? Find out how using tax depreciation correctly can give your investment strategy a major boost and send your wealth soaring. Hey everyone, it's Kim Koch from Duo Tax, here with another video designed to help you become a smarter property investor. If you're like most people, you've probably been feeling the pressure of high housing prices and the fear of missing out on building wealth through property ownership. But what if we told you there's a way to have your cake and eat it too? That's where rentvesting comes in. Rentvesting is a property ownership strategy where you buy a property with a high rental yield in one area and rent it out while you live elsewhere. This not only allows you to invest in property and build wealth, but it also gives you the freedom to live in an area that suits your lifestyle, even if you can't afford to buy property in that exact location. We've done a separate video about the pros and cons of using this strategy to get your foot in the door, which you should check out if you're still deciding whether or not you should take the leap. But in today's video, we're going to show you how you could be missing out on some serious cash by not utilizing the tax benefits that come with rentvesting, especially depreciation. Let's dive in. Traditionally, buying a house means purchasing a property as an owner-occupier. You live in the property, build equity, and then use that equity to secure a second property to start your investment journey. However, this strategy comes with a catch. As an owner-occupier in your first property, you don't have access to the tax benefits that investors do, such as depreciation. Sure, once you buy your second property to use as a rental, you'll have access to those benefits, but only if you're generating income from the property. This is where rentvesting comes into play. Not only does it offer the freedom to live where you want and buy where you can afford, but it also gives you access to these tax benefits from the get-go. That's because with rentvesting, you're not living in the property, you're generating income from it. This means that from day one, you have the opportunity to maximize your wealth through the power of tax benefits. So, how can claiming tax depreciation save you money? Well, claiming tax depreciation can save you money by reducing the amount of taxable income you report on your tax return. When you own a rental property, you can claim a tax deduction for the decline in value of the structure and its assets over time, like kitchen appliances, carpets, and other fittings. This can significantly lower the amount of taxable income you report, essentially reducing your tax liability. And if you're reducing your liability, you're potentially improving your cash flow, making it easier for you to manage your rental properties and continue to build your wealth over time. Let's take a look at an example. Martha, who currently lives with her parents, saw an opportunity in the market to buy a brand new apartment close to the city for $675,000. Unfortunately, she's not yet in a position to live in the property and pay off the mortgage without generating some extra income. So, with the support of her family, she decided to pursue a rentvesting strategy. Continue living at home while renting out the brand new apartment. She manages to secure a tenant at a weekly rental of $525, which generates a yearly income of $27,300. The property's total yearly expenses to cover interest repayments, management fees, rates, and maintenance are $36,333. Now, let's look at how this impacts her tax return. She's currently running at a loss of $9,033 without depreciation, so her property is negatively geared, and this will offset her other taxable income. If she falls into the 37% tax bracket, her tax refund would be $3,342. This will put her into a negative cash flow of $5,691. Because the property is a brand new build, we let Martha know that she could claim $16,500 in depreciation in her first year of ownership. Now, if you take her depreciation claim into account, her total loss increases to $25,533, which means she can offset her taxable income even further. This means her new tax refund would amount to $9,447. This is an increase of $6,105 thanks to her depreciation claim. Even though her property was operating at a loss, because of the tax refund, her overall cash flow position is now positive at $414. Can you see how increasing your tax savings through rent vesting can make the strategy even more appealing, the potential for higher returns and improved cash flow is too good to pass up. So, if you're in the same boat as Martha and would like to find out more about how DuoTax can help you with a depreciation schedule, give us a call today. We'll see if your property is eligible and give you an estimate of your savings. And if you're happy to proceed, we'll then put together a depreciation schedule that will outline depreciation on your plant and equipment assets according to their effective life, depreciation on your structure of your building, the different depreciation methods, and how you can continue to claim depreciation deduction on your tax return. Once it's ready, we'll send it to you and your accountant, who can then submit it with your next tax return. I hope this video has provided you with valuable information on the benefits of rent vesting and how to maximize your tax savings through depreciation. Remember, when it comes to real estate investing, every little bit counts, and taking advantage of these tax benefits can make a big difference in your financial future. If you have any further questions or want to learn more, please feel free to leave a comment below or check out our other resources. Thank you for watching, and don't forget to like and subscribe for more great content.